Uh, again, good afternoon. I'm delighted and honored to join you today's special program. As Mayor of City of Cerritos, I'm proud to present a proclamation recognizing two exceptional physicians, Dr. Bharat Patel and Dr. Anil Shah, for their contribution to the community. Dr. Bharat Patel worked as a urologist in Beverly Hills and in Downey for the last few decades. In 2014, he started Associations of Indian Physicians of Los Angeles. The association itself funded and provided free clinic visit, laboratory exam, ultrasound, and surgery for thousands of people in Southern California who do not have the resources or insurance to pay for their health care. The association also arranged for medical seminars for physicians on cutting-edge subjects and participates in other education projects and health fair. The organization planned to build a surgery center and clinic for parties who do not have the financial availability for healthcare. The Association of Indian Physicians of Los Angeles was honored with Best Free Clinic Program in country in 2018. On behalf of City of Cerritos and City Council, I am delighted to honor Dr. Patel with proclamation for his effort to give back to society, providing free healthcare. There's a proclamation which I'm going to give it to Bharat Bhai, was already provided, but his proclamation of City of Cerritos is giving you on behalf of our city. And also,
thank you very much.
It is also my privilege to recognize Dr. Anil Shah. Dr. Shah is an award-winning cardiologist and successful entrepreneur who has made positive and lasting impact in the world throughout healthcare. Dr. Shah has practiced as a cardiologist for more than 35 years, and he is the founder of Orange County Physician Investment Network, which purchased 4 community hospitals to sustain and provide better healthcare to local residents. He has invested in actively participated in real estate development, biotech, startup, and food surgery center. In 2016, Dr. Shah founded the Smart Village Initiative, and since then he has adopted more than 30 villages in India. The Smart Village movement has engaged with state government in India and cooperate with village entrepreneurs through its alliance with UC Berkeley. Together, they have provided an open innovation platform in agriculture, connectivity, education, energy, healthcare, livelihood or sanitation, and water. On behalf of City of Cerritos and City Council, I am pleased to honor Dr. Shah with proclamation for his effort to increase the overall standard of living and quality of life for countless people. Here's proclamation for Dr. Shah. Thank you very much.
Thank you, Dr. Salanki. Thank you very much for joining today.
Thank you for this opportunity to recognize Dr. Patel and Dr. Shah for their contribution to medicine and society. Our community appreciates their commitment to serving to less fortunate and improving the lives of the others. I wish them the continued success and hope everyone enjoys today's program. Thank you.
Thank you again. Welcome joining today. Good evening, everybody. And this is again Dr. Sudhakar Jonalagada, President, API. And we have a very, very exciting program today. I invited physicians to talk about how to manage money. You all know that we have financial advisors and also other entities, can help us to do money management. But I would like to see the physician prospect, how they're going to do this, which is very important because we work very hard. We don't have much time, and we don't sit in the television and watch stocks all day long. We have very exciting faculty today. I want to introduce the today's speaker and moderator, Dr. Bharat Patel. He is a practicing urologist from California, and also is the founder of Allocation. He is a chapter in California, and I heard a lot of things that they do a lot of charity work there, including the free surgeries they were offering to the community. And I would like to see what you're going to say about the stock market, investing, and the cryptocurrency. Anyway, each speaker will have 20 minutes. And after that, we have 20 minutes question answers. And this program is only for information purpose only. API is not endorsing any recommendations. I want to understand that. Thank you very much. Please welcome Dr. Bharat Patel.
Hi, good afternoon, good evening, everybody. I'm Bharat Patel, as Sudhakar mentioned. And thank you, Mr. Solanki, for being with us and giving us the proclamation. And my theory is that every talk, every meeting must start with a joke. So I'm going to tell you, somebody asked me that how you become a Bitcoin millionaire. And I told them bit by bit. A guy walks into the bar and says he orders a whiskey. And the bartender gives him a whiskey and the guy paid by Bitcoin. And says that, so bartender says, no, we don't take Bitcoin. So he says, Bitcoin, it will, by tomorrow, it will become into $1 million. So bartender takes away his whiskeys and gives him a glass of water and tells him that by tomorrow it will become whiskey. So let's start, stock market in general is a very huge topic. Physicians are the victims of a lot of sharks, and we all have to be very careful. We protect our money. Don't be greedy. Greed and fear are the worst thing you can have. So I advise everybody that asset allocation is the most important thing. All your assets must be allocated in different things like stock market, real estate, collectibles, rental properties and things like that. Don't put everything in stock market. And once you decide what you want to put in stock market, always decide that for next 5 years, you are not going to need that money for your day-to-day maintenance of your life, paying bills, paying insurance premiums and all that, or your children's education. For 5 years, you're not going to use that money. Then only you invest in stock market. We are all at a very late stage in our lives, so we all make mistakes. But these are the basic principles. Now, when you invest money in stock market, you have to invest in a diversified way. Diversification, particularly in different sectors. The most important way you can make money in stock market is you got to recognize which sector is right now very popular, which sectors are working right now. Like in recent days, everybody knows that technology is out of favor right now. So instead of technology, if you invest more in financials or energy or biotechnology, your money will grow faster. So deciding which sectors are most important at present is the most important fact in making money in the stock market, not into the selection of the stock. And in each sector, you select the stocks which has a good business. You look at the business overall, company, their earnings, their revenue, and if their earnings are projected to be better than what it is last quarter or last year, then that company is better. If the revenue is going to be projected better. And moreover, for that, all the analysts who are analyzing each stock, they must upgrade the stock before you buy it. So revenue, earning, upgrading, that's most important. And which sector you put the money is most important. These are the general advice. And physicians have a lot of investment clubs, and you can get together, make an investment club of your own, and have meetings on Zoom. And physicians are more smart than professionals. I have seen it many times. We get professionals in our clubs to give a talk, and then physicians ask them questions, and we make much better decisions than them because we have common sense. All the professionals, they go by their company's philosophy, and we go by common sense. So do talk to your colleagues, your friends in the community. Don't make decisions yourself. And you need to study a lot. You need to read basic things. There are no special volumes of books you can read. Just read Yahoo Finance, read CNBC, read Barron's, read Investor Business Daily. And after a few days, few weeks, you will get a pretty good idea about how things are working and what should I invest in. So today I'm going to concentrate on cryptocurrency. Right now, that is the talk of the town. So I'm going to start my screen sharing. Can you all see this?
No.
No. Let's see. Vijaya, how do I do this?
Please
Oh, I
click
got
on
it. I got it now. Okay. You can see this, right?
Yeah.
Okay. So this is the last slide. Let me go to the first slide. This is the sensation of the time. This is the Bitcoin. Anybody and everybody you ask is talking about Bitcoin nowadays. And I'm just going to give you a basic understanding of Bitcoin. So what is Bitcoin in 2021? Today, the price of Bitcoin close to about 56,000. I made these slides just 3 days before. So today the Bitcoin is, one Bitcoin is worth 56,000. So what is the Bitcoin? It's a storage of value in a blockchain. What is a blockchain? It's a computerized chain of numbers, letters, characters with barcode in it. So it's just like a, if you say, what is your name? And there are 26 letters and 10 numbers and several barcodes in it. And that's called a blockchain. And it's created in 2009 by a guy named Satoshi Nakayama. Now about Mr. Nakayama, nobody has seen him. Nobody has heard him. He posts things and a lot of people believe that his real name is not Satoshi Nakayama. So
Bharat bhai,
Bitcoin,
yes. Can you enlarge the screen? Enlarge.
Is better now?
Yeah.
Okay.
Thank you.
For a urologist to understand all things, it takes time. Huh? So he created Bitcoin in 2009. So Bitcoin is a very, very recent thing. But it's an ultra secure data presented as a blockchain. Nobody can hack a Bitcoin, the blockchain. Data can be, this file can be sent to others and it is worthless without that barcode in it. Different types of Bitcoins exist. One is called Bitcoin. Another is called Ethereum, Litecoin, Dogecoin, XRP, Tether, USDT. So there are different, but right now the most popular ones are the Bitcoin and Ethereum. So we'll talk about them. Now, what are the characteristics of Bitcoin? You cannot spend more than what you have. You can only spend what you have. This is very important. You cannot copy it. You cannot duplicate it. And it can be traced. Who gave it to whom and who bought it from whom, it can be traced. And it is decentralized. There is no middleman, no banks, no governments. And it works on this Bitcoin or a cryptocurrency network by this passing of this blockchain. It's a chain and no middleman, no governments involved. And it's used as a medium of exchange of value and storage of value. So you can store, like you put your money in the bank, or you can buy with the money. You can do both the things with Bitcoin. And it's a decentralized finance. You can get a loan in seconds and you can spend it easily and very fast. So these are the characteristics of Bitcoin. And then we go to the numbers. Well, how many Bitcoins exist in the world? 21 million are allowed. That's it, forever. So it's a scarce commodity. Government prints dollars. Bitcoins cannot be printed again and again and again. So far, 18.5 millions have been mined. So mining of Bitcoin is a very huge process. You need a lot of computer power, electricity, brain power, and then finally you come up with the blockchain, and that's the Bitcoin. So rest of the Bitcoin, they say it will take about 100 years to mine. So 21 million are allowed in that Bitcoin community, and 18.5 millions are mined so far. Now there is a process called halving. So if you make a new Bitcoin, you mine a Bitcoin, they give you a little reward. Now that reward gets cut into half every 4 years. So that way the number of Bitcoins produced are much, much less. So it's gonna be a scarce commodity. And whenever it's a scarce commodity in demand, the value of the commodity goes up. What are the advantages of Bitcoin compared to like dollars or gold? It's an hedge against inflation. You know, people, when inflation comes, people run to dollars, silver and gold. So Bitcoin is cryptocurrency is going to be the hedge against inflation and hedge against falling dollar. When the dollar is shaky because of the manipulation by Federal Reserve or the government, the Bitcoin will be a safe haven for people to put their money in. And it can be used anonymously without revealing your identity. That's the advantage. At the same time, it's a disadvantage also. And not a single time in the history of Bitcoin, the network was hacked. And that's an accomplishment. You all heard that just last week, Microsoft was hacked. And if Microsoft can be hacked, me, Anil, or Sudhakar can be easily hacked. So Bitcoin network has never been hacked, so it's very, very secure. And eventually they're predicting that it will end up on the central bank balance sheets like gold and Swiss francs and other assets like treasury bonds. It's a safe haven during the uncertain times. Moving further, why you think Bitcoin is going to increase in value over the time? Because if you want to invest in Bitcoin, you want to make sure that the value increases. So one thing, as I told, the scarcity is built in. There are only finite number of Bitcoins can be produced in the world. And that halving reward is going to be cut every 4 years. It cannot be devalued because it's not controlled by any central authority like Federal Reserve or government. And now the most important thing why Bitcoin is increasing in value is the mainstream and institutional adoption is happening. It's giving us the credibility which Bitcoin was lacking before. Big companies are investing in Bitcoin or producing Bitcoin. Like Square, PayPal, they have like hundreds of millions and billions of dollars now invested in Bitcoin. BlackRock, some of the big banks, MicroStrategy, Tesla has put 1.5 billion in Bitcoin. Mass Mutual Insurance Company has allowed several billions to be invested in Bitcoin. Guggenheim Fund wants 5 billion in Bitcoin. So after all this institutional adoption, the Citibank evaluated and said that in 2-3 years, Bitcoin price will go to 100,000. And if you never heard about the lady called Kathy Wood, she's a ARK investment manager, and she runs several ETF. And right now she was considered to be the most smart and the astute investor. Last few days, her name is being a little tarnished, but she will come back again. So she predicts that Bitcoin will be 500,000 by 2024. Now, her calculation goes this way, that Bitcoin eventually going to replace gold as a currency reserve, as a go-to in inflation and bad times, because gold is a very heavy material, has to be stored in a vaults. Jewelry is another thing, but so she thinks that if the Bitcoin has to replace gold as an inflation hedge, Bitcoin has to reach to the value of gold. Now, right now, in the whole world, the gold which is stored in the government storages and banks reserves is worth $10 trillion. Now, right now the Bitcoin's value is about $800 or $900 billion. So to reach $10 trillion from 56,000 Bitcoin price, it has to go to 500,000 if it replaces gold. So that's her prediction. Now CME, Mercantile Exchange, is allowing now future contracts on Bitcoin. hedge funds are involved too. And the financial guru, Jamie Dimon, is very popular among financial, but he used to be a skeptic. Now he sees opportunities. So the main purpose of this slide is that the institutional adoption of Bitcoin is becoming now very, very fast, common, and very large. And that is giving people like us also some confidence that Bitcoin not gonna go away. And now people like us are going into Bitcoin. I just saw a sign in Santa Monica the other day which says, buy Bitcoin here. So it's becoming, very a fad amongst common people, and they all want to get into Bitcoin. So that's the ultimate measure of success. If the common people are not involved, then Bitcoin cannot succeed. And we are worried about the government, but Biden administration and Janet Yellen, in recent remarks, they're as usual, they're supposed to be cautious, and they have to be cautious, but they are not against it. They say that there should be guards against abuse of Bitcoin by money launderers or black marketeers. So eventually government will have to follow the institutions and the people, and they will do it. They will turn on a dime. So individual investors going to play a big role in the adoption of Bitcoin as a common currency. Gold will be replaced as hedge against flailing dollar and inflation, and market cap of crypto is to go to $8 to $10 trillion to reach the level of acceptance by gold standard. So in that case, Bitcoin predictions, I'm throwing a lot of numbers at you just to see that what can happen if Bitcoin is adopted as a very valuable and very important hedge against inflation. And because of all these things, cryptocurrency is producing a tailwind for itself. It's getting pushed by the mania for Bitcoin. So if you like gold, there are many reasons you should like Bitcoin. That's what Mr. Cameron Winkle says. He's a financial guru. What are the disadvantages of Bitcoin? What can go wrong? It's a very risky currency. It can be used by money launderers and black marketeers. So there will be, guards and regulations and rules set for avoiding all these things. And this is true about dollars or any kind of assets. Money launderers and black marketeers are using it anyways. Our currency is not free from those kind of abuses. Another thing in Bitcoin terminology is called wallet. Suppose you own Bitcoins and you store it in a thing called wallet. It's a digital thing, it's not a wallet, but you must have a password for it. And if you lose your password, Bitcoin network cannot give you that password. You are doomed. And right now they say about $5 to $10 billion are lost because people have lost their passwords. So if you are big into Bitcoin and you have a wallet where there are soft wallet and hard wallet and all that, don't lose your password, and also give your password to somebody in case you disappear. And right now, because it's a beginning, lots of volatility in the price. Like when I made a slide, it was 50,000. Today it is 56,000. It's like 12% increase in 3 days. And different government and regulatory commissions are going to eventually, come into play, and they will have some regulations to control the abuse of Bitcoin, and that's going to happen. We have to assume that. Now, how do you get Bitcoin? We talked about Bitcoin, what it is a hedge against inflation. Is going to increase in value, how you can store it and all that. But how do you, like a common person like you and me, how do we get into Bitcoins? You can buy it with your real money from your bank account. Now there is a company called Coinbase. They just sell Bitcoin and other cryptocurrencies. So you open an account with them. It's a very tedious process of opening account with them because they are being they want to be very cautious. They want to be very careful about, bad characters getting into their act. So I opened an account with Coinbase, and it's very easy. Once you open the account, you transfer money to Coinbase account, and then from there you can buy Bitcoins, Ethereum, whatever you want to buy. And you can check everything at a click of a time, a click of the computer mouse, and you can get your money out by selling it also at the same time. So suppose the price goes up and I want to make some money, I can sell. So Coinbase is one company. It's going to go public in next few days. You can also put money in, there are funds or a management, it's a hedge fund. I'm just putting this name. I'm not promoting this company, but it's a very popular name called Pantera. Pantera, what it does is they have 4 kinds of funds. One is a plain Bitcoin fund. You put the money in their Bitcoin fund, they manage for you, and they charge you 0.75% commission. So you just put 100,000 minimum is the amount, and you buy Bitcoins through that Pantera, and they will manage and give you report. You can check online. And there are some other funds where it's called Digital Asset Fund, and they manage your account with hedging techniques and different manipulation of Bitcoins, and their returns are, in last 11 years, they have a 40,000% return. So a very, very established, legitimate company. You can also buy Bitcoin by buying stocks in the companies. One company, such company is called Riot, Mara, GBTC, BTCC, BITW, MSTR. So these companies are either involved in buying and storing Bitcoins, or they are also involved in mining Bitcoin and arranging for the software for the management of Bitcoin. So you can buy stocks on most of them are on NASDAQ, and you buy and sell every day. You can buy things with Bitcoin on PayPal, Square. You can sell merchandise using Bitcoin. And Bitcoin right now is treated for tax purposes as your short-term and long-term capital gain tax. So if you keep the Bitcoin for more than a year, it will be a long-term tax. A word about Ethereum. Ethereum is a second most popular cryptocurrency than Bitcoin. It was invented in 2015, 6 years later than Bitcoin. And it's an open source smart contract software. So anybody can use it, anybody can develop their community, and people are predicting that Ethereum will be more popular than Bitcoin over the time. Today, the Ethereum value is $1,798. So that's another popular Bitcoin. Now, I have a slide about questions, but we will keep it at the end. Thank you all for listening to me. And now I'm going to introduce Dr. Anil Shah. Everything has been said about him, which has been said. The only thing they didn't say is he's my best friend. And we get along very well, and we go all over the world to see World Cup of Cricket. So, Anil Shah.
Thank you. Can you make me the host, please?
Yeah, you are the co-host, Krishna.
Can you see everything? Can you see anything or no?
Not yet. Okay, we got it.
Okay, so I'm going to talk about technical analysis. And it's very important, first of all, to understand. Okay, so let's look at the agenda. I'm going to talk about fundamentals first. The Greek symbols, which, of course, some people use. It's not really important for professionals on a daily usage. I'm going to talk about 3 different tech analysis oscillating index parts, which is the MACD, Bollinger Bands, not bonds, Bollinger Bands and RSI. and how it helps to create the entry and exit points, when to sell a covered call and how to buy calls and when to buy calls, because really that's a very important part. People lose their shirt buying calls. And of course, I want to talk a little bit about my uh, NGO, if time permits. It's something which we all should be participating because we want to make India really a great country. So first of all, we should talk about the fundamentals. As Dr. Sudhakar said initially, we don't have time. Doctors are always very busy. They cannot sit in front of TV and computers to really look at what's going on. So there are new companies, and of course there are matured companies. So in a new company that's coming up, all companies put at the bottom of their screen what they're all about, and they write it themselves. So they really create a lot of hype of what they do, and they may even say more than what they really do. But they create a hype, and people get kind of sucked into that. They are, of course, innovative. They have new products, they have new processes, and new discoveries. So all these things really make the companies really go up in value. And initially, after the IPO is really created, the values are very, very high. And then sometimes they fail to impress, and the stock is volatile, usually downwards, and then their stock prices go down. So I think it's very important that when you start the investment, at least for the young professionals or the people who are new in the stock market, that they really participate in some matured companies, because those companies are really kind of very reliable. They've got a great reputation. They do continuous innovation. They have increased earnings from quarter to quarter, and they predict increased earnings by increased beat. And they also have strategic acquisitions so that their bottom line increases. And therefore, one has to be really certain that we initially participate in matured companies. And for example, you got FANG and many of the other Dow 30 companies are great companies to invest in because there's significant demand from institutional investors and mutual funds. One thing we have to understand that we are very small traders or small people in the stock market. And therefore, we never really create a change in the value of the stock. The value of the stock is really determined by institutional investors and mutual funds and what they buy and sell. And therefore, many of the matured companies, they have a predictable rise over the long term, and therefore they get admitted into the S&P 500. So now let's look at the comparison, just for sake of understanding. If you take Google, the market cap is 1.4 trillion. The shares outstanding is 674 million. Now look at Apple, it's 16.79 billion. So Apple has got 24 times the shares, outstanding shares of Google. So Google has a earnings per share of $57 a share per year. Okay, Apple only has $3.70 because it's cost 24 times. So, but if you really look at it, the entire earnings of Google is $38 billion a year, while that of Apple is $62 billion a year. But after you take into consideration the annual dividend, their value is $92 per share. Now, if you put into Google's relationship, look at the P ratio. They're kind of similar, So really, the real value is 62 billion after the dividends are given. But in relation to Google, it's $92 per share. So between the two companies, I mean, you got a company that's doing 38 billion and 62 billion, you can sleep at night very, very easily, very happily, not to worry about it, because these are the real great companies of the world. Now, of course, we have been talking about GameStop, initially. What happens? The only shares are 69 million shares. That's it. Now, I understand that they've got 5,000 shops all over the country, and they've recently changed their management. So the stock is going up like crazy lately. But the management is not proven. So really, when you try to really keep your, rely on new management to come up and change the game, it may not be so easy. But there are other factors really participating in it. They're losing $4 a share. So really, there is no earnings at all. There's no dividend. And therefore, their earnings are, they lose about $291 million a year. So you have to understand what companies you're participating in and what companies you should participate in, because as physicians, sometimes we tend to keep the stock for long term. We don't like to sell the shares because of tax issues and things like that. So many times, if you want to sell the shares, you should try to be within the pension plan or IRA or a non-profit if you have one. I mean, I have a non-profit, so I really participate in that and put my money into the non-profit, and the non-profit account keeps on going up and up. Now, so in a way, what you have to understand is that anytime you buy a stock, you need to buy a stock which is reliable, at least to start with. Look, for example, Amazon. Amazon you got here, it is earnings are $41. And here you got Tesla, is only 62 cents. So now, what is the reason that Tesla is becoming $573 billion company? It was actually much more. But the reason why it's happening is because it has got new innovation. It has got the platform. I went to buy, to look at an EV vehicle, and I went to Audi, and they were selling me e-tron. So I asked them, what is the e-tron going to do? And why is it different from Tesla? The guy would not tell me. The car drove beautifully, but at the same time, e-tron cannot change its platform. You cannot have continuous upgradation of your car that Tesla has given you. So Tesla is, in a way, a very innovative company, and therefore the stock keeps on going up. They keep on creating new processes within themselves and new discoveries, as a result of which a Tesla is always going up. So if you've got a company that does not do that, the stock market is not going to rise. However, look at the P ratio. The P ratio is 961 compared to 71 for Amazon. Now, once upon a time, even Amazon a few years ago also had a P ratio of about 500 or so. But what is happening lately in Amazon? The stock remains between a range of $2,900 to $3,500. It does not keep on going up. It keeps on going up to 3,500, comes down, keep on going up and come down. What it really is doing is that the P ratio is gradually coming down. So if you expect Tesla's P ratio to be 961, so what does P ratio mean? P ratio means that in order to earn $1, you need to pay $961. That's a price earnings ratio. Therefore, if the P ratio is so high, you have to understand that over the next several years, as more EV vehicles come in, the P ratio will kind of gradually, come down. Now look at CCIV, which is a new stock right now. It is a stock which has got an open checkbook, and they acquire companies, and they have 258 million shares. Again, a big hype going on. There is no earnings, and it has a value which was about $100 or $75, and it came down to $25 in a matter of a few weeks. So the hype is very important that you don't allow yourself to get into, because if you go into a hype, you are actually really going to beyond Las Vegas, and you're putting money in a way by which you can lose money very, 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 very rapidly. So let me talk a little bit about the Greek symbols, okay? So alpha means what is your return on investment? Most of us sometimes have these institutional investors who participate in our, who take our stock portfolio, and you never know what they do. I've always lost money with institutional investors because they never give me a good return. So you always have to ask them what your alpha is. If alpha is return on investment compared to the broad benchmark. So if it is 3, for example, it's 3% greater than the benchmark, minus 5 means they lost 5% of the benchmark. Beta is volatility. Now you will see it in your overview of the chart that they will tell you what the beta is. Beta means it is a highly volatile stock. 1 means it's neutral. Now delta is, of course, goes into the speed at which the option, this is the option part of it, is the speed at which the option prices change. For example, if the speed of option changes from $1 to $2 very rapidly, that is what the speed is. But sometimes it's different from gamma. It's an acceleration index. So, for example, for the same price of the stock, it accelerates tremendously, and therefore it is good for forecast because if you're a buyer, but if you're incorrect, the high gamma is the enemy for you. Now look at this theta. This is a very important slide. So this is the time decay. So when you're buying options, for example, and if you buy an option which is like, say 120 days, you see what the time value is? So when you buy an option, you pay not only for the option for the purchase of the stock or the right to sell the stock, but you also purchase the time value. So as the time decays, the value of a stock decreases. So in the first 30 days, there's a slight decay. In the next 30 days is more. In the next 30 days, it's even more. And finally, the last 30 days, it is really a precipitous fall. So one has to be very careful when you try to buy a option. When you buy an option, you want to make sure that you buy an option at the right price. So for example, when you buy an option, you're not only paying for the time decay, you're also paying for the premium for the stock, and the multiple forces going on, including the volatility, which is the beta part of it. So it's important that, so when I buy an option, I usually buy an option which is long-term. And therefore, because I have the time to make sure that I have the ability for the stock to go up. So say, for example, if the stock is $100 and the option price in 1 month is say $10, let's say it's a 10% premium. At the end of 60 days, it won't be another $20. It will be much, much less than that. So at the end of 120 days, it may be 20% or 25% or so. It won't be 10, 10, 10, 10, like 40%. And therefore, you need to keep the time on your side. One more thing, what you do is, now, if the stock is going to be exceptionally volatile, where you feel that the stock is really going to go up like crazy, then you can buy out of the money, means beyond your strike price, okay? But if you have a stock which is not going to be wild and volatile, then you may want to buy something which is within the money so that you don't pay a lot of premium. And you will see in the stock price indexes that as you go in the money, slowly and steadily, the stock price may go down by $5, but the option price may only go down by $2.50 or so. So therefore, sometimes you have to try to make sure that when you're buying or selling something, you take that into consideration. Let's talk about technical analysis. Technical analysis, MACD. So it stands for Moving Average Convergence Divergence. Now there are 10 different types of all these technical terms, or technical oscillators, as you call it. And I go for 3 which are most common, I think, which is most popular. I mean, everybody can have their own ones, but these are the most popular ones. So the MACD stands for Moving Average Convergence Divergence. It is calculated by subtracting the 26-day exponential moving average from the 12-day period EMA. Okay, so there's one line of the MACD, and there's a signal line, which is a 9-day moving average. Now, if you look at this one, so let's see what happens. Here is, I'm drawing here okay, so here's a line that is going forward, which is a MACD line. It keeps on going like the market gyrations. And this is a very important line. It moves very fast, and you can see what is going on. Now, when you take the other one, which is the 9-day moving average, it will go and either cross it and remain parallel to it to a certain extent. So let's draw it. So here is, we are drawing it, and it goes down here, and then it crosses it. It again comes up here, again goes down, again crosses it, and again crosses around. So when this happens, when it crosses here, that means you are at the highest part and it's going to go down, therefore you should sell it. Okay. Here, when you try to do it again, you should, it's going down all the way, and therefore this is a time to buy the stock. And I'll show you within the, as you can see in Disney, you can see what's going on. So here is the sell again. So look at Disney, for example. When the MACD line crosses the situation and it crosses this point, this is the time to buy it. And you can see it in a histogram here. And so you'll see the histogram also comes here. So what happens in the histogram, you take it to a certain extent, and of course, as it grows less and less here, it'll come nearby. So some people take it at a point to really buy from here in a way so that you can go forward and you will try to buy it at this particular point. So look at here. You can see here that the thing is going downwards, and therefore this is a time that you will try to buy. When it crosses the 2 lines, is the time to buy. It goes down, again it will go down. But of course, it's above the zero part of it, so it's still not gone down. But when you buy a stock here, and if you keep it, this is the time when it goes down that you may want to buy a covered call, because now you can do a covered call, so the covered call will not get called off. For example, if you get I recently bought a covered call on Riot, which is a Bitcoin company, and the price was $50 or so. It was trying to go down. So what I did was, because it was very volatile stock, I bought I sold the covered call for $100, and I got about $8.50. Amazing premium, So, okay, so I had 1,000 shares, so I made $8,500 from that. And obviously then it went down, And then I rebought it back for $1.50. So actually I made $7 a share without any kind of a problem. So then the other one is the relative strength index. Now this is a momentum oscillator that measures the speed and change of price movements. So you can see here, of course, this is a formula. But the most important thing is the relative strength. You have to take the average of how many days the stock is up. So usually they take 14 days. So you can also take a 10-day moving average. So you count the number of days the stock is up, and you count the number of days the stock is down. So take, for example, if you're $10 stock, and if it's up by 6 days, so it's 60 divided by 10 is 6. And if it's 4 days, it's down by $10. 4 over 10 is 4, so it's 4. So 6 divided by 4 is 66. So what happens is that, and of course, there's a formula to create these graphs, and the graphs are created automatically by the software company, so you don't have to really calculate anything. But when the RSI is over 70, that means it is overbought. And when the RSI is less than 30, it is oversold. So many traders, what they will do is that they look at the RSI, and when the RSI is over 70, they will try to sell the stock. And when the RSI is below 30, is a time for them to buy the stock. There are some also further indicators known as the bullish divergence and the bearish divergence. And these are more complicated things, but that can also be seen from the stock. The important thing about the technical analysis that you do is that you have to really look at it on a daily basis for every stock. It's like trying to understand medicine. You can't just practice medicine the first day you really become a doctor. You've got to really practice over the years and therefore get experience. So when you buy a certain number of stocks and you are part of it, you will be able to see what this graphs really mean. Now, the third technical analysis is a Bollinger Band. So look at, this is the Bollinger Band. This is actually, so let's take, for example, this is a 20-day moving average. And then there is a 2 standard deviations where there are the up and down. So the 2 standard deviations are there. And this, of course, blue line is a stock market. Now, I have to give Bollinger Band for 1 year. And look at, this is Deere, John Deere. It went from $19 to $339 in a matter of 1 year. And as you can see, if you look at the Bollinger Band, it's all on the upside, as up from the moving average, all the way up in real stocks. So you can look at the Bollinger Bands from the stock and see how your stock is going to do. So you can try to decide whether you want to keep the stocks or not. The same thing is true here. You can see the stock here, same company, 3 month, look how the stock is moving up. So keep on keeping up with you. You don't have to worry about that because now the stock is going up continuously. Now, what happened to Tesla? So Tesla also, of course, the same thing happened here. It went on keeping up and then went up all the way. And of course, then it went down. It crossed this and it is continuously going down. So now what you can see here is that look at this point. Whenever the band becomes very, very narrow, that is the time when there will be an exponential rise or fall of the stock. So it's very important to see the bands here. When you see the bands here that are coming here, that is the time where the exponential increase in the price of the stock. So you need to understand that when you try to do a 1 month, and I'll show you some examples of that. So say, for example, you do a Tesla and you take a 1 month here, look how it's going down, continuously going down. So when it goes down continuously, you have to worry about the fact that the stock is going to go down. So let's try to combine all these 3 things together. You cannot have a stock and just take a single indicator and try to play the stock market. You want to take all the 3 different ones that at least I do. And of course, I'm no expert, I'm just trying to, over the years, I've just learned it from my own mistakes. But as you can see, there is a close band here. So if this was here, it would have gone up because it has gone down. So like here, it was up on top, it went up here. Tesla, same thing, Tesla, okay, it went up. But then then it remained very, very neutral and then it went down. So when it remains neutral, the stock market also can fall down too. So that's or keep on going up sometimes. So you have to be very careful where you're doing. Now, again, the band came here. When the band came here, I did not know whether it's going to go up or down, or it went down. So then it keeps on going down. So I think the P ratio, to my mind, plays a very important role. Not many people believe in it sometimes, but on the long term, P ratios are an important indicator of what a stock is going to do. Short term, it doesn't matter. Now, so here we saw Tesla. Now look at this one. It is ARKG, which is a Cathy Wood stock, the investment. It came here and it went down to a great extent. What happened here? You look at the bands. So it's a band, for example, it went on continuously. It's parallel. The histogram shows that it is down, and the RSI shows that it went down from about 64. It was not overbought. It has gone down to 46. I look at this one, MACD, all the time. When it crosses, I get a signal whether I should be entering into it or whether I should be getting out of it. Now, obviously, if we are in a tax bracket, especially in California, the taxes are just unbelievably high in the state. We are all very concerned about the taxes. But if you have the IRA account or the pension account or your nonprofit account, there is nothing to worry about. Now, what I do is I keep the stock, but then I would try at this stage to sell a covered call so that I will be able to recover some part of my money, because sometimes you can get 8 to 10% a month. But when I sell a call, I sell it for a short term because I never know when this will come back again. Of course, you can buy back your call too. There is no problem behind that. But you generally will gain in selling a covered call when it is significantly out of the money. So look at this one, Disney, for example. Lately, it has been going up. You can see that. For some time it went down. And the stock price went down, and then it, of course, went up again to a great extent. I'm seeing a lot of comments here, but I'm not reading them because I've got a full screen in front of me. So here we've got a G, for example. Lately, it has been just going up like crazy, and you can see this one. Now, sometimes it is not a gold point. Gold point is like a straight line here, like a divergent view, and you'll be able to see that's a gold point because that is the time that you really get into it. You can buy a call and you can really make some capital. At the end of the day, capital is very important to buy stocks. What you make in your practice is only your living. And if you invest into that and if you lose it, you'll feel very, very bad. But if you want to create capital, you have to really trade stocks to a certain extent or get some other income. And you can see here that some of these stocks are overbought and they are oversold. And therefore, you have to look at all of them together simultaneously. So when you look at some things which are there, for example, if you're here and you're going down, you know that it's going down together. And even here, the RSI is also going down into this situation. So you can probably at this stage say, boy, do I really want to keep the stock or do I want to keep the stock and sell a covered call? So you have to buy the calls based on this kind of a parameter, and you have to sell the calls based on the trends that you can see in this situation here. So, I mean, I can demonstrate right now, but I think we got less time. But if somebody wants to see a demonstration, please let me know. I just want to talk a little bit about my nonprofit, if you don't mind, for a second, so we can look at that. And so we've got a smart village movement, and I'm in alliance with the University of California, Berkeley. As you know, Berkeley is one of the best universities in the world. And we have created a partnership with them by which we create smart villages throughout India. And what we do is how to create a smart village, really. That's a very important part of it. No one individual can create this. No one organization can create it. It's only the companies and the entrepreneurs that can create that. So what we do is that we build infrastructure villages and we empower them by connecting them to global ecosystem by which the people can sell their goods and markets through digital technology. So we have a professional relationship with UC Berkeley, and I'm honored to be a builder of Berkeley also at the same time, to the Center of Growth Markets. And what I do here is that we take the government, so we go to the government. For example, I went to the government of Andhra Pradesh. I talked to Chandrababu Naidu. I went to the government of Arunachal Pradesh and the government of Meghalaya, and we talked to the government, and the government gives us a contract. They pay us some money, which is not very much, but they pay us a kind of a small money to UC Berkeley and to us. And we then connect with the businesses and with the universities. We have about 200 students right now coming in April from all the IITs, including the Berkeley students. And they are given projects to really start working on those things. I mean, I don't want to really talk about a lot about these things, but you can see it's me here. It's the Chief Minister of Meghalaya here. You see the CTO of Salesforce. You see Tech Mahindra here. You see the Chief Secretary of the Government of Meghalaya here. And we've got all these companies which are from Microsoft, Amazon, Dell, Wipro, IBM, Salesforce, Oracle, all the top 500 companies of the country, of the world are participating in it, including Indian companies like Tata Chemicals and Geo, Reliance, and everybody is there. So right now, for example, we've got about several villages in all these other companies that are participating with us. And here is in Andhra Pradesh, we've got a Hella, which is a German company, teaching them how to do automotive repair. And 600 students have been done. Here is also swing for the ladies, And this is now in Meghalaya. We've got an old building, converted them into this one. Now, therefore, there's a pathway here. It's a polyclinic. So people can do telemedicine, things like that. We got drones that give to the people in the mountainous areas vaccines and medications. These are people who keep the villages clean. So this is like recycle of the plastic materials, etc. So anyway, we've got many universities also that we participate in, and we've got a platform of our own. So this is really a very innovative platform, where companies come in, put their challenges, the students come in and put the challenges and the solutions, and that's how we disseminate the solutions to the people. And our aim is to really create, at a time we create 50 smart villages in a district. And from that particular knowledge, the government gets the information, and then the businesses go to them and they spread it to the whole state. That is what our whole idea is. We want to convert the whole country, if we can, into smart villages, because without the villages being converted into higher level of living with increased GDP, India can never be a great superpower. Thank you very much.
I am going to now introduce Dr. Erwin Mehta. Erwin Mehta is a friend for a long time. He's a nephrologist. I'm a urologist. So as you can see, I use knife and he's using the brain. And that's where he's going to come into picture today. He's going to talk about options. And options is right now apart from Bitcoin, is the most talked about thing in the stock market, because if you want to make quick money, they say you got to learn option. So Erwin, we are all here to learn option from you. Go ahead.
Thank you very much, Bharat Bhai. First thing, it was a very impressive and excellent presentation by both Bharat and Anil. Very good. I'm very thankful to both of them. I'm very thankful to particularly Api and Bharat Patel to give me the opportunity to just talk about the basics of the option, because the option itself is a very big subject and it's very complicated. So whatever I can do, I will just try to do it. Why did I choose the options? Let me just talk about me just a couple of minutes. I'm an internist and nephrologist, practicing in Long Beach, California for many years. There were some few catalysts even occur in my life pertaining to investments and all. I had a money manager from 2001 to 2012. And he invested all of those money in mutual funds. I invested roughly 500,000 with them. After 11 years, from $500,000, I got $490,000, and he made $130,000 in his commissions. So you can see that why it is so upsetting. Number two, the Wall Street gurus, they really brainwash you. If you ask anybody, you can make more than 7 to 10% per year throughout these many years and all. And this is all hogwash, and I will just tell you about that. And number three, of course, the change in healthcare now. We do not have any more patients. We have got the lives now, which are totally owned by the HMOs and IPAs and all. So for the same amount of the money, now we need to work double and triple. And I'm telling you, we are not getting younger anymore. Another thing is we are also losing the entire grip with the patients and all. So that's another, these are the few, then I thought about it. You must have another stream of the income. And then I decided to jump into stocks and options. Well, I knew about this about 15, 20 years ago, but it was all trial and error. And let me tell you, my old friends, that trial and error is very, very expensive way to learn anything, okay? They say that anything enthusiasm without the knowledge is very, very dangerous. That's why in order for you to do options, even basic options, I think we need to be very, very educated and we need to practice a lot, okay? So I want to make a point today that options should be a part of every stock portfolios. And that is going to give you a very handsome return. It has given a handsome return to me. And that's why I'm just talking to you. I'm going to share the screen now. Okay. Okay, can you see that?
No,
Okay, okay, share. Okay, I'm sorry. Can you see that now?
not yet. Yes, yes, now we can see.
Oh, now you can see. Okay, good.
Okay.
So yeah, this is the first slide. Just I'm going to just talk about the trading options. So first thing, I must try to tell you about why I like options and why options should be the part of our game. And there are 8 reasons I would say it should be a trading. You should have the trading options as a part of a portfolio. Number 1, options can easily double or triple your money. Okay. When you are right, when there is a call options, let you profit from rising stocks. If you have put options, let you profit in the beginning. And especially in the time of the high market volatility, we are talking about historic volatility, options can be very welcome as an income as a whole. Number 2, option safety provides you with the leverage. Imagine you have to buy Amazon. Who the hell can buy the Amazon? 100 shares of the Amazon will cost you $300,000. How about if I just do one option on that and it may cost me only $500? So $5 multiplied by 100 is $500. That $500 is going to now control that $300,000. So I just love it. If the people do not have, unless I have hundreds of millions of dollars, I would have bought a lot of Amazons. But otherwise, best thing is to have just options. Number 3, the option reduces the risk. And I'm willing to bet that you have an insurance on your car or house. Same thing. If you want to insure your portfolio, you better have some insurance. And this you can achieve by just buying some puts. And there's so many other ways you can do it. I will not go in detail about it because of time. Number 4, the options allow you to trade all markets. Okay. If you do just simple stocks, you know, either market goes up, market goes down, either you may make money, you may lose money. But here with the options, it does not matter whether it moves up, it moves down, it goes sideways. If you have strategy, there is always a way for you to profit using these options. You can be very positive. There are more than 20 to 30 ways, strategies of options, but you don't have to learn all those things. Number 5, they used to say that options are just tools for the elite anymore. And I do know about 15, 20 years ago or more, you know, it was only meant for the elite that they will call the brokers and anything. Not anymore. Now options, you can easily do it just online. Number 6, as I say, the option let you start with a very little money. In fact, you have in some brokerage company, you may require deposit of only $2,000 or less.
Yeah.
And you can get money. Number 7, option has never been easier to trade. And it's my first.
4:37. I'm in a Zoom meeting right now. I'll come straight. Okay. Thank you.
Yeah,
Thank you for that.
okay. Options have never been easier to trade because I do remember about 15, 20 years ago, I had to call the brokers for either buying or selling the options and all, and it was very tedious, and plus it was costing a lot. Now, very easy. You can open account in anywhere, trade stations, Fidelities, or any or TD Ameritrade, or anything, anywhere. It is very, very easy for you to open and trade. And remember, this is the one thing I love it. Options let you create almost unending income. Okay. Today, I have been doing this options for last more than 7 to 8 years. Last 3, 4 years, I got a real good grip. And I should tell you, all of us being a physicians, at present, I'm just enjoying the medicine, and I don't have to work for the medical part. So I'm just go and have a good time in the medicine, because my income mainly is coming from this options. I'm going to go very basic because a lot of these people might be knowing this basics of the options, but I was told to just talk about it. So that's what it is. So, and I will go a little bit faster. Okay. What are the options? They are just to standardize the final contract, and it gives an option gives a buyer the right, but not the obligation, to control a set number of shares of an asset at a certain predetermined price. For a call buyer, it is that's called your right is to buy the asset, and for a put buyer, the right is to sell the assets. Okay, this is easy. Now there are 2 types of options. That's it. There are only 2 types: calls and puts. If you buy a call, you gain the right to buy 100. Remember, 1 call is equal to 100 shares of the underlying security. If you buy a put, you gain the right to sell, not buy, sell 100 shares of underlying security at the predetermined rate. Now, you got to learn, you got to know certain basic terms here. And when anytime you want to buy or sell the options, it has got 3 components here. Number 1 is a strike price. Number 2 is the premium. And number 3 is the expiration date. What is strike price? It's a predetermined price agreed upon by both the buyers and the seller of the options, at which the call buyers can buy his shares and put buyer can sell his shares. Very simple. Now remember one thing, the call options with the strike price below the underlying stock current price will be more expensive. Giving an example, if the stock price is $100, okay, and if you want to buy the call at 95 or 90, it is going to be much more expensive than the strike above the stock current price. Giving an example, if you want to buy 110 strike price, it will be much cheaper than 90 price. That's what it means. Number 2 is what is a premium. Now, premium is determined by the number of factors. Okay, this is very important. Number 1, what kind of option it is. Number 2, current price of the underlying asset. Number 3, the price of the options. And number 4, the time remaining until expirations. As Anil Bhai clearly mentioned about that, time is very, very important. We call it a theta here, which is the Greek term for that. And number 5, of course, the volatility, both historic volatility as well as implied volatility. Again, implied volatility is very important when it comes to these things. It's a different subject by itself. Expiration date. Now, this is very important. Every option has a set date in which it expires, called the expiration date. Okay. In the US, there are 2 kinds. Okay, it's American and European. In American options, you can control, you can close, you can open anytime. In the European options, you cannot close until at the end of the expirations. Okay, so most of them are American, so you don't have to worry about it. Okay, most option traded in the US expires on the third Friday of the designated expiration month. But there are many other kinds of options, okay, I will tell you. Everybody has heard of the LIFs. LIFs are nothing but the acronym, which is called long-term equity anticipations securities, okay, which is 9 or more months to expire. Okay, so giving example, today is this is the March. So anything 9 months from there, say in January something, you will call it LIFs. Then there are so many options. SIBO has got the Chicago Board of Exchange. Has got so many products now. Now they are coming out with the 30 days, 60 days, 90 days, 120 days options. Okay. There are also quarterly options, which expires on the last trading day of the designated quarter. Then there are weekly options. That is for every Friday that thing happens. Well, everybody knows about call option buyer, right to buy, and call option seller, right to sell, so I would not go for that. Same thing about the put option buyers and put option sellers. Because of lack of time, this is quite basic, so everybody knows about it. Okay, this is very important slide. This is the call strategy review. Okay, this is a typical graph that Anil Bhai was talking about, the same thing. Any stock, if you go, it has got a demand level and supply level. In other words, we call it demand level, means when it goes to support, they call it, you can call it a support also. Supply, you can call it as a resistance level. What of the, so if you can see when it goes to the resistance and then it comes down, then it goes to the supply, then it goes support level, and then it goes up. The problems with the majority of the novice or new beginners, what they do is they buy the stock when it's already a resistance, thinking that, oh my God, it's like thinking that they are FOMO, fear of missing. This stock has gone up this much, oh my God, it may go further. Not knowing that this is a time majority of the institutes, banks and other brokerage institutes, they are the one, they are going to sell it. Look at what happened. Next thing, right, it goes down. Then it goes to the demand level. Demand, this is support level. What happens to the novice or beginners? Oh, they get kind of fear. Oh my God, it may go down further. And then they sell it. Banks and other institute and brokers, they love it. Now you lose money, they make money. So this is the way, this is a very important graph. Reading an option quote. So how to read that? Is it done 5 IBM September 170 call at 4:30? What does it mean? 5 means number of option contracts. You should know that. 5 multiplied by 100 shares. That means you are controlling 500 shares. Number 2, IBM, the underlying subject to the term of contract, it may be Apple or Google or whatever, there are 3,000 stocks like that. Number 3, September. There's the option expires on a 3rd Friday of this month, which is September. If the expiration date is not in the current year, the year will also be shown. Okay, then it might be next year, year 2020 or something. Then they will show you September 13, 2020. 170 call is the strike price. Okay, giving example, if the current price of the IBM is at 200 and the strike price is 170, that means it's in the money call. The price at which the IBM stores will change hands if exercised. And calls, as you know, either is call or put. At 4:30, 4:30 is the price, is the $4.30 that you pay the premium per share. Okay, so for 1 share, you'll be paying $430, means 100 shares, you'll be paying $430. Remember, I talked to you about option as an insurance. Very, very important. If you remember last few days ago, NASDAQ, there was a corrections, almost like more than 10 or 12% or something. If anybody who had a put, bought the put, not this time, but for, you want to buy the put when the market is quiet, okay? At that time, the premium will be much lesser as compared to when the market is hot. Then when market goes down, you are not going to lose that much money. As I said, put option is an insurance. I told you about that. Moneyness, this is very important. Everybody talk, what is in the money? What is at the money? What's out of the money? So moneyness is a measure used to determine when you should sell an option rather than hold it until the expirations. So I talked to you before, a call option in the money when the call strike price is below. So if below the current price of the underlying asset, as for example, XYZ, current price is 100 and your strike price is below 100, say 95. That's called in the money. For the put options, it's just the opposite. A put option is an ITM in the money when the put strike price is above the current price. Giving example again, if the XYZ is $100 strike price, and then if you are buying 105 put options, that's called in the money, okay? This everybody knows. If you are saying this, when you go to any brokerage account and when you want to choose your strike price, here it is. It clearly shows that. Calls on left side, on the right side is the puts, bid, ask, strike price, net change, open interest, volume. There is a delta and all those things are there, okay? That you will know. Now, remember I told you put option as an insurance. If you have got a, say, giving the example, $100,000 for the portfolio, the full insurance cost is roughly around $2,500. What it means is you may have to buy, say, roughly around, and may have to pay roughly around $2,500 just buying the puts. When the, sorry. When the SPY declines 20%, if you don't have insurance, you will be losing $20,000 without any protection. Let me show you this way. With the $100,000 market exposure, with the put protection, what happens? Market falls 20%. So 20% of that is $20,000 loss. But look at that. If you have a put, you bought a put worth of that you have to pay only $2,500. Okay. So what you'll be losing is only the cost of the buying puts. So instead of losing $20,000, you are going to lose only $2,500. Very beautiful. Everybody should consider that. Then we are talking about intrinsic and extrinsic values and all. So I'll just go a little bit because of the time problems here. I'll just go very fast and I'll conclude within less than 5 minutes. Intrinsic value plus time value is equal to premium. As Anil Bhai was talking about the theta value, that's a time value. Okay. So examples there, if there is a stock price is say $52, okay, and you paid $3.25 for the strike price of 50. So what is the intrinsic value? Simple, 52 minus 50 is $2. Okay. So what is the time value? $3.25 minus $1.20. I'm running out of battery, sorry. Just running out of battery. Should I close it? Sorry, I'm running out of battery and I got to hold it. I like right. Just a few seconds, okay? I'm sorry. That's it. Thank you. Sorry. So time value will be $1.25. Now, as the time passes by, this you are going to just get, that's you call it vestige. That 125 will become $1 and then 50 cents, and then there is nothing. So that's why you have to be careful. Now, when to buy or sell options? Very simple. Well, it looks simple. When you think that stock price will rise, you do two things. Either you buy the calls or you write the puts. Write means you can sell the puts. But if you think the stock price will drop, in that case, you want to buy the puts and you can sell the calls. Okay? I already talked to you. I don't want to go into too much detail. As I was telling you, the time value is it's a decaying, it's a vesting asset. When it goes down, say from 60 days away, then it becomes 30 days away, 15 days away, then becomes 1 week and all, and slowly it's going to erode that $1.25 that you gave. It becomes zero at the expiration. That's why you have to be very, very careful. And I already talked to you about the intrinsic value, historic volatility, and implied volatility. Everybody has to know what I'm giving example. All these FANG stocks, they've got very high historic volatility, very high implied volatility. Giving example, Tesla, look at the volatility it has got. So when there is a high volatility, you can compare that with the SPX volatility. Giving example is the VXX, because VXX is meant for the SPY. If that volatility is around 20, if you talk the implied volatility of the Tesla would be in the 50s and 60s and 70s. Today it went up by $100, $100+. If you had sold your calls, I mean, if you had sold the premium, you would have gotten a lot of money, and that's what I did today. Greek summary is there, and there are delta, vega, theta, gamma. I would not really go in detail about this. I just want to say about one most important out of all. Delta is the most important one out of that. In a simple term, what happens that delta is a numerical value given to each option that shows how much that option premium will move with the next $1 move in underlying stock. So I will give you an example. Okay, you have got stock which is say around $50, and you have a call option which is 60 cents. That means when the stock goes up by $1, the premium of the call option on that stock will go up by $60, 60 cents. What does it mean in a money wise? On a one contract, which is equal to $100, that means 60 cents is equal to 60 multiplied by 100 shares. It's like $60 you can get on one contract. Remember, if you have 10 of them, you can imagine that. Look at the power of the option that you can have. Okay. Now, opposite is true of the put options. We'll not go in detail about that. And vega, theta, gamma, it has got their own place, but we usually, I mean, it is meant for me, it's meant for too much professionals. So I would not dwell into that. Order types, everybody knows: market order, limit order, stop limit order. I would not bother that. Order type: buy to open, buy to close, sell to open, sell to close. Again, we'll just go over that. This is too much now for today. Just add extra slide: bullish, bearish, non-directional and directional. Again, I will not go into this. But thank you very much, and sorry for taking a little bit of time. And again, I really appreciate both Api and Bharat to let me just give some little bit of my 2 cents on basic options. Thank you very much. How do I?
We just unmute Dr. Bharat Patel.
Share screen. You want to turn it off?
Okay, I got it.
Bharat, we would like to take some questions.
Sure, definitely. To any one of us. Yeah.
It is just some chat box, I think.
On the any questions, please type in the chat and I can answer.
The first question is to Dr. Mehta, I think. So what is your go-to option strategy?
What is my, I'm sorry, I didn't get the.
So the question is, what is your go-to option strategy?
What is my personal option strategy?
Yeah.
Go to, yeah.
Okay. Well, I've taken quite a bit of a few classes and I've been taught you should be like an insurance company and you should be like a banker. They clearly mentioned always believe in selling. I would never buy, I would hardly ever buy anything, buying calls or buying put, unless the market has gone down so much. And then I can buy the calls and I can really jump on it. It's like a lion, you jump on it. But more than 90% of the time, I sell. Now there are various strategies for the selling. Okay, either you can do cash secure put, or you can do credit spreads. Either you can do bull put credit spread, or you can go bear call credit spreads, and quite a few other things. Yes. But these are
Thank
two
you.
things.
The question to Dr. Anil Shah. How do you research companies to trade options?
Well, my strategy has always been that I want to be in limited number of stocks. I know people sometimes go to 100 stocks, 150 stocks. I think that is a mistake because your energies get frittered away in multiple areas, especially when you don't have time. So I like to really be within about 30 to 50 stocks, depending upon your portfolio size. I think if you've got $1 million, you should not be more than 20 stocks. If you've got $5 million, you should not be more than 30 stocks. With $10 million, you should not be more than 50 stocks. I like to be within that limit, and I study that stock every day, quickly. It takes me about 10 seconds, 15 seconds, and I go through it every day, so I know exactly what is going on. And when you look at these three parameters on a continuous basis, you'll be able to see, you'll get a grip of it, you'll get a sense of it. And as you get a sense of it, you'll be able to understand what exactly is to be done. But those three particular the three parameters that I talked about are something that is dear to me. I look at it every day and I know I can predict. Even when my friends buy it, I said, well, in my mind, I say it's a mistake, but what can I say, because everybody has to have the freedom to do what they want. And I try to advise if I'm asked. But the thing is this, that it's very important that, see, money lost is money lost. You have to double the effort really to gain that money back. The $100 stock give is now at $50. That means you have to double your income, double your return to 100% really, to just break even. So 50% loss or 40% loss is really not acceptable to me, because it's better sometimes. You cannot win each and every trade. You don't want to, because that means you're too conservative. You want to make sure that your trades are properly done. But as I said before, if you look at the price of the stock, if you look at the Bollinger Bands and the MACD lines, if they're crossing, you know when to buy or when to sell. Now, when you want to hold a stock, you better sell a covered call, or you buy a put. Buying a put means you're really trying to buy a hedge your stock when it goes down. And believe me, sometimes you make a lot of money by buying a put. Now, I understand Dr. Mehta only wants to sell. He's a smart guy. He always wants to make money. But in stock market situation, you have to buy and sell so you can maximize your returns. Now, some stocks are so volatile and they go so much up. And say, for example, my RSI value is down to less than 30. I want to buy a call because I want to make sure. Now, you must know, you must read this more often so you can understand the bullish divergence and the bearish divergence also. There are certain graphs in it by which you can see which are the peak points. The peak points are rising to the next one. It may mean that it's going up. If they're going down, it may mean that is going to go down. So you have to understand. So most important thing is keep on reading the charts. Keep on reading the charts. Don't just keep on. Please don't follow blindly, because blind means blind leads the blind. Doesn't work. You've got to really understand the charts and try to understand it. You'll make a better return than just buying the stock.
Yeah, thank you. Another question also for you, that one of the participants asking, what happened to the GME stock this afternoon? It dropped so much suddenly after the CNBC news.
Well, I did not hear the CNBC news, but as I tell you, I would not go for the GME stock. I think it's a high flying stock. I try to be away from high flying stocks because I don't see any intrinsic value. And even if there is intrinsic value, let them prove it. Yeah, there were 5,000 shops. I'm very impressed with this, but the shops are losing money. So what's the point of buying that stock? I want to see the intrinsic value of the company first before I do anything else. Now, if you buy something because you are so confident of a short-term situation, like a day trader, and you want to just buy it because it's gone up, then that's fine. You can catch it, but then you better make sure that at the end of the day you create your cash so that you don't have to really lose it. So CNBC obviously is going to, I don't know what they said, but whatever they may be, I think it's a high-flying stock and there is no earnings, so I'd be away from it.
Thank you. A question to Dr. Mehta, Erwin Mehta. Do you recommend any book to understand options?
Well, there are a lot of free seminars, free webinars available in a YouTube. That's the best way to do it. But there are a lot of options, a lot of things are written on options, basics of the options and all. And there are a lot of authors for that. I like this YouTube options seminars. So many of them are very basic and all. And if you spend enough time, I think at least you will learn basic. But at the same time, I just want to caution everybody, it's not that easy. When you learn, you should just start doing a simulation. Every brokerage company will give you simulations. Okay, they will give you 200,000, $500,000, whatever you want it in simulations. And start trading that after you go through this basic teaching and all. And then you will find out what mistakes you are making. Once you start getting a control, after that, you can just really go on your real brokerage account. Thank you.
Another question on options, Dr. Mehta. Dr. Ravi Kohli, Vice President of RP, is asking, comment on poor man's covered call option.
I'm sorry, what about that covered call?
Poor man's covered call option.
Okay, now covered call is quite a big topic, but I will tell you what I do in covered calls. First thing, to do a covered call, you want to make sure that your stock is of high value, it's a good stock value. Giving examples, all those FANG stocks, multi-billion-dollar stocks of value, I would really do on those. On those particular stocks, I will do cover calls. Rather than if they are very highly volatile, just upcoming companies and all, I would definitely not do cover calls on those. Number two, cover call, the way to do it is you need to find it out that what is this average true range, ATR? Is it weekly? Is it daily? Or is it monthly? And then please look into typical, if you get any brokerage company, Fidelity, Trade Station, TD Ameritrade, it will show that expected move of that particular stock in that particular time. Giving example, if the stock, if you are buying or selling the stock at, say, around 30 days from now, okay, it's a 9th of April. On the left-hand side, no, on the right-hand side, it will show what is the expected move. Giving example, Apple, okay, on 9th of April, if you want to buy a call, sell a call, cover calls, and the right-hand side, it will be written, oh, this call, this may move 9 point something or $10 up or down. That means if it's $100 stock, it may go down to 90 or it may go to 110. Now, if you want to keep this stock, if you love it, you do not want to do cover call at 100 and when 100 or something. So what I will do, I will look at the expected move, so which is like say $10. So 100 plus 10 is $110. So I will do cover calls around 112 or 113 or something. That way, two things are happening. I'm keeping my stock. I'm getting appreciations more than 90% of time. And number three, I'm getting the premium from the cover calls. Thank you.
Thank you. Question to Dr. Anil Shah. What do you recommend to read or watching increase the knowledge on stock market? Do you hold stock for long term?
Okay, so I have made many mistakes in my life. I do not know whether I have or not, but I think this in the stock market, what I do, I have always believed that stock market at the end of the day can sometimes get into depression. So you better hold something solid. I made a lot of money in stocks and then I invest in real estate. So one time I had a $2.5 million gain. I took all the gain and I put it in real estate and made my real estate portfolio that way. So I own a large real estate portfolio. I also own stocks in a big way. My friends help me out. But what I do is I read IBD, Investors Business Daily. It's a great newspaper. The leaderboard and their RS ratings, as well as the top 50 stocks and how you can, and they teach a lot in terms of the graphs, etc. The cup and handle and all those things are great. So I like that a lot. And of course, then there is so much information on the Yahoo and even your markets, CNBC. I listen to it all the time. So all these things help me. But at the end of the day, you have to choose the stocks. See, a stock is like buying a company. I think if you try to say that I'm buying this company, then you say, hey, which company should I buy? Would I buy Apple or would I buy GME? I think I would like buy Apple because I can sleep at night easily. Buying options and creating options is a kind of a stressful situation sometimes because you got to really keep your handle on this very, very carefully. And sometimes you don't have time. I mean, I'm an interventionalist. I do interventional cardiology. So is it easy for me to really go and look at the stock market when I'm doing an angioplasty intervention? No way. So we have to be very, very careful. And each individual person has his own strategy to make the money. But in any way, you would never want to lose money. That's the most important thing for me.
Thank you. Dr. Bharat Patel, a question to you. How much of your portfolio you allocate to Bitcoin and options, etc.?
Bitcoins, I will advise a average investor to put about 2% of your money in Bitcoins. If you are an aggressive investor, 5% right now, not more than that. An option average, I think not more than 10% of your portfolio should be in the options. That's much safer way of doing it. Or you can just open another account and put whatever you want to put in options strategies and just use that account for options, because option is a kind of a greedy thing. If you make money today, you want to invest more tomorrow, and then over the few days you will realize that 50% of your money is in options, and over the next 3 weeks you will realize that out of that 50%, 30% is gone. So just be disciplined. That's my answer.
Okay. So another question, I don't know who are the three speakers can take this. Which MAV are good to use moving average?
Anil,
I'm sorry, I did not hear the question.
which moving averages are good to use if you have to choose one or two?
Well, I mean, of course, you got your 50-day and 200-day moving averages. They are kind of broad principles. But I look at the 20-day moving average in my MACD, which is the best for me. And of course, the Bollinger Bands, and MACD is the 25 and 9. exponential ones. I only use 2 of them. I don't look at anything else.
Okay. I think we are pretty much running out of the time. This is the last question. I know the answer. So I say surprisingly, all speakers are Gujaratis. I know the answer. They are good money managers. Thank you.
No, Sudhakar,
Okay.
we thank you and Api for allowing us to present our passionate, beliefs and knowledge to a group of intelligent doctors. And I hope we contributed to their understanding, and we'll be ready to come back again anytime you invite us. And all the best to you and Api.
Thank you. Thank you, Dr. Bharat Patel and Dr. Anil Shah and Dr. Erwin Mehta for taking your time and joining us this evening and educating our members. And definitely we will invite you again. And again, stay safe. Good night.